Let's move on to credit cards. This is also explained in my Common Banking Services video. Credit cards allow you to spend the lender's money anytime, and pay it back at a high interest rate. You don't need one, but many choose to have credit cards because of convenience, rewards and cashback, and building credit. There are standard credit cards, business credit cards, student credit cards, store credit cards, reward credit cards, secured credit cards, and more. Schumer boxes show you everything you need to know about a specific credit card. They include APR, annual fees, grace period, credit limit, fees, and rewards. APR stands for annual percentage rate, which is the total cost of borrowing. It contains the interest plus other fees you have to pay in a year. Using credit cards responsibly can help you increase your credit score, which is like a scoreboard of your financial competence that lenders can use to decide if you are trustworthy with money. Missing payments, having loads of debt, and defaulting on loans can all decrease your credit score. Paying expenses on time, building a long credit history, not using all your available credit at once, and mixing credit types can increase your credit score. Credit is one of the ways to pay for things. Others include cash, debit cards, layaway, and rent to own. And buy now, pay later, or whatever. Before I move on, I have to show the difference between payment apps and digital wallets. Payment apps let you transfer money and receive online payments. Digital wallets store your debit and credit cards. So, that's credit. Let's talk about goals. Financial goals. It's best if you have some. Before you start using the knowledge I've shown here, it's recommended that you set goals to guide your financial decision making. First, know your money personality. There are many online tests you can take to figure this out for yourself. The personalities are usually spender, saver, investor, and balancer, which is a combination of the previous three. After that, you can set goals that align with your money personality. These goals should be specific, measurable, achievable, realistic, and time-bound. SMART for short. Your goals can be short, medium, or long-term. It's best to have different goals that fit into all these time bounds. Lastly, here, I want to talk a bit about net worth. This is literally how much you are worth, financially speaking. This is your assets, what you own, minus liabilities, what you owe. You may have a negative net worth, which is fine as long as a plan to increase your net worth is in motion. Onto the topic of loans and debt. You can get loans from banks, peer-to-peer, title loans, and payday loans. Do your own research before choosing where to borrow from. There are two types of credit: installment credit and revolving credit. Installment credit means you pay off the loans in installments with interest until you've paid off the entire principal. E.g., personal loans and mortgages. Revolving credit means you can borrow from the same line of credit again and again, but it's limited, and you still pay it off with interest. E.g., credit cards. Loans can be secured or unsecured. Secured loans require you to put up something valuable to get the loan, called collateral, while unsecured loans don't require that. The interest rates on loans are either introductory, fixed, or variable. Introductory interest rates are temporarily low rates that increase after a set period of time. Fixed interest rates are just that, fixed, for the entire loan term. Variable rates are subject to change. There are two popular ways to pay off your debts: the high rate method and the snowball method. The high rate method works by paying off loans with the highest interest rate first, then the second highest, and so on. This is the more mathematically sane way to pay off your debts. You'll pay less interest overall on your debt slicing journey. The snowball method works by paying off the debt with the lowest balance, then the second lowest balance, and so on. This is more psychologically appealing to do, and so it's easier to stick with, because you're motivated after the easy win. What's important is that you actually start paying off your debts, man.